I do want to say, while this was an inheritance, let me talk to people who didn't ask this question but might be in a similar boat. Whether you have received inheritance money or life insurance money, this is a conversation that we have very often from both of those resources of funds, that somebody is rolling along and all of a sudden here's this lump sum. Now what? And I love that Maggie mentions the mortgage and the remaining balance, because that is the most common first point of the discussion about what do we do about the mortgage. And I will say we are big, huge fans of you going into retirement without a mortgage payment, but it is not necessarily in your best interest to pay this off at the beginning when you first receive this money, because one of the variables, Scott, that we don't know is whether this is a pre-tax or post-tax dollar amount. If this is traditional IRA money, then it's got to be taxed, and frankly, it's got to be taxed. It's got to all be exposed to taxes within the next 10 years in this inheritance type of scenario. So that's a possibility, or it might be all after-tax money, and that's a very different end result in what you can do with this. So the first thing that I would say is pretty much an absolute, and that is to not pay the mortgage off in one lump sum, because that permanently impacts the ability that you have with this $250,000 to do other things for you, Scott.
Yeah, and I think the back to the how has it been received and inherited. If it is in an IRA, we probably should take just a second to go over the change in law there. We've talked about it before on the show, and Maggie, if you've worked with a financial advisor wherever the inherited IRA came from, you may have already heard this, but for everybody else listening, in the past, prior to the Secure Act of 2020, when someone received an inherited IRA from a parent, most likely, they had the option of stretching those IRA distributions, which are called required minimum distributions, over the course of their lifetime. So in other words, if your father, if Maggie's 55 here, if your father or mother passed away and they were the last surviving parent and they were 80 years old, they had been taking required minimum distributions. A certain percentage of the balance had to come out every year. When you inherited at age 55, you would have still had to, in the past, take that required minimum distribution out. It just would have been a much smaller amount.
My mother-in-law passed away in 2019, and my husband is in that situation where he has, and his siblings are as well, where they all have a certain amount each year that they have to take out, but they have the ability to stretch that over their lifetimes. They can take it all sooner if they want to,
right.
But Maggie, with a recent inheritance, again, if this is traditional IRA money, then you are subject to a 10-year timeline on that.
That was the change in law in 2020 in the Secure Act. So if it was a recent death, then it certainly would apply that you would have to take all of that $250,000 out of the IRA over a 10-year time period and pay the taxes on it. So every time you took a distribution over the next 10 years, if you took $50,000 a year, it would be stacked on top of whatever your current employment income is or household income is. So it could be taxed at a really high level, and you would not be able to utilize all of that $250,000. However, if it was the sale of a home and you got to step up in cost basis, or if it was a life insurance policy, that would not be the case, and you'd be able to use every dollar of that $250,000. So the next variable for me, though, is I kind of focus in, Janet, on she's 55 and she wants to retire at age 65. So we've got a 10-year time frame to prepare a retirement income plan.
Right.
And Maggie, if you haven't done that, I would encourage you to do that, because we don't know how much Maggie has saved for retirement.